Hello, I'm Greg Bell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights that boost your trading potential. Coming up, U.S. markets are trading lower. We got renewed trade tensions, tariff woes. Same caution is pushing silver prices higher, with safe haven demand lifting precious metals, while those equities pull back. We're going to dig deeper into all of that and the small caps, which have shown resilience after their recent run. Plus, our trader debaters are standing by. They're here to tackle the bull and bear cases for consumer giant P&G. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Martin Luther King Day yesterday. Of course, the markets were closed. The Americans are now catching up to a lot of geopolitical news. All this drama over Greenland, the threats of tariffs are escalating. And also, bond yields spiking in Japan. The big sell-off in Japanese bonds. Having a chance to get really deep into that story, but of course they found all the usual suspects worried about economic policy. But they said it started off as a pretty quiet day in Japan before they started to have that drama. You can see right now the S&P 500, a fairly sizable pullback. The pain is sort of across the board. So let's show you the board. Let's jump into the heat map and see what we have on our hands here. You got all the big tech plays: NVIDIA, Apple, Google, Microsoft, Broadcom. To the downside, it's spreading over to names like Amazon and Tesla. Financial services, I'm not getting a lot of green on that part of the screen. Little pockets here and there. Intel is up, Micron, so some of the smaller chip plays. But across the board, we got a lot of selling. Let's check it on JP Morgan. That stock is down with the rest of the financials. Of course, over the weekend, there were threats from President Donald Trump that he would sue JP Morgan Chase. He's been alleging they debanked him following the January 6th riot in the U.S. Capitol. And so that's a name to watch. D.R. Horton, earlier in the session, and by earlier I mean in the pre-market, we actually had a climb of about 3% for the shares, but they're sort of starting to get pulled back with the rest of the broader market. They did have their earnings. First quarter results came out beating expectations. The earnings stronger than expected, and the revenue line quite firm too, $6.89 billion. And the market was looking for $6.59. So not a bad beat on the top and the bottom, but it is a day of selling in the U.S. markets. And that is your market update. Joining us now for more technical take on what's happening out there in the markets is Hiran Amin and Jason Natick from our direct investing educational team. These are not dull times, gentlemen. Every once in a while, I look forward to a dull day. I don't want too many because we have nothing to talk about, but they're not dull times. So give me the Russell 2000. What's happening here?
Greg, they're few and far between this year, it seems like. So, but yeah, let's talk about the Russell 2000. We're looking at the RUT symbol, which is the index for the Russell. The big question is, can the little guys keep up with the big guys? And if you think about the big tech rotation, it would suggest, yes, they are. As we see, like, investors are moving and rotating into, money into other pockets of the market. And not only do we see other sectors broadening, but we also see it broadening across different capitalization levels, and namely into the small cap space as well. If we look at the performance-wise, Russell has gained about just shy of 8% year to date so far. And if you compare it to the S&P 500, which is at 1.4%, so it's according to FactSet data, that's almost like 3 times the outperformance right now that we're experiencing. And then on a growth basis, if we think about EPS growth for fiscal 26 and what analysts are saying, Jefferies analysts put out a note that they expect about 14.6% growth for 2026, which is going to surpass the large caps, which is sitting about 13.8%. Namely, in sort of the space that's probably going to be buoyed up the most is financials make a big part of the Russell index, almost 30% in fact. And with a steeper curve and acceleration in capital market activity, that could also be the boost to it. But if we look at the charts, I mean, it's a thing of beauty, is how I would describe it. You can see we've covered Russell quite a few times on the show, Greg. But going back, after it broke its downtrend after the summer, it's resumed this very big bullish channel here. And I've kind of marked it with an upper red line over here, you can see. which is now acting as an overhead dynamic resistance. And then on the bottom, we've got this green line, which is very much respecting, barring what we had at the sell-off in the end of the year where it just came out, but on a weekly close, it was back up in that channel. So going into the next quarter or this coming quarter, I do see this channel being very well respected. On the downside, we could see it test back and bounce up. On the top, we could get rejected off of this resistance line. Also, a key moment was just at the start of this year, you could see I've drawn another uptrend line, and you could see it was being rejected at these different levels, and we just saw a break. And what do we know about whether the breaks are a fake out or it's in fact a true breakout? Is we want to see a break, we want to see a retest, which we did see over here with this candle. We did have a gap down today because of the markets being down, but it's firmly resting on this level over here and moving forward. So that'll be an eye to keep out on. If we do have a sell-off, I do imagine it going back into this dynamic support resistance just at the 21-day and just sitting at the 50-day EMA, which is in this blue line over here. But let's see, momentum squarely in its favor. RSI and MACD are still positively trending upwards there as well to corroborate the story.
There's the small caps, resilience in an uncertain world. An uncertain world also has metals rallying. You're taking a look at silver. Yeah,
we're looking the lesser known, or actually the well-known brother, but the silver kind, the white metal, of course. It's running hot right now. So, I mean, you talked about the drama that's really unfolding. This is really given an extra leg up. So just to recap, over the Greenland spat, the U.S. is potentially putting on tariffs 10% to begin with, going up to 25% as of June 1st if it does even get enacted. But not only that, there was reports that the European nations were also preparing responses to Trump's salvo, including a $93 billion worth of tariffs on U.S. imports, but also possibly even restricting American companies from access to the continent's markets altogether. So that's going to be something to keep an eye out on. The other part of this is we've seen volatility tick up with silver quite a bit. We've seen after it's had its historic run in 2025, 140% gain is what silver came off with. And this rally, I wanted to just paint a picture because it seems like if you look at the charts, very reminiscent. The only last time it did this was back in the 1980s. And if you remember in the 1980s, the Hunt brothers were trying to corner the silver market and just bought up all the silver. And in fact, for almost 2 or 3 decades, that was the highest price silver had attained, about $53, and we only broke it last year to where it is right now. But what's different this year, no one's trying to corner the market, unfortunately, but it is structurally different because you have demand from sovereign wealth funds, governments, but also its industrial application industries also using it there. And then the last thing I'll mention is China has been really tightening the screws on its exports of silver because they just feel like for domestic production, they won't have enough. So that's also led to a premium, and that's what I wanted to show on the charts. If we look at the recent price action on silver, I've just kind of noted it going into the last quarter from October. We saw this normal cup and handle pattern form, which we were seeing silver kind of take a break at that 52 level. It did finally break out of it, and now this has kind of started that big bullish run. Again, I've created this bullish channel over here, but what I wanted to show was the channel's expanding, and we've seen a big uptick in volatility, especially at the end of the year and going into this year with the geopolitical tensions that have been arising as well. But this has also created what's known as backwardation. And backwardation is an element where the spot prices, in fact, are trading higher than a futures price. So the market's pretty much ignoring, storage costs and everything else associated with buying the future pricing on this. So that's one to keep an eye on. But we also saw the biggest divergence between, you can see the 50-day moving average to where silver is. It's also made a new high today. It's the largest move from its 50-day moving average in, I think, since going back to 1987. So it's run up quite a bit, and usually we do see a little bit of profit taking or some share decline. But if we do see it, I do see it anticipating maybe possibly pulling back into that 83 level from its 94 level. So this is one to keep an eye on. But 100 is where analysts are saying it could even tag in the coming days or weeks as well. We're not too far off of it.
1987, grade 10 for me. I don't want to hear from you guys. It might be pre-birth for you. Anyway, Jay, I understand your family's in the market for a new car, and you've got a short list of Ferraris on the show.
Oh, you're right. That's that would be real nice. I'm sure my oldest son, he'd be real excited. I don't think they'd fit the winter tires though very well. That wouldn't be too great. But yeah, we are going to talk Ferrari, and we've debated talking about them on the show before. But I just want to highlight this isn't the most sexiest time, and the reason we're going to be talking tracking them, and we're not even going to be using this as to talk about this toned down expectations for 2026. They're already expressing weakness looking forward with shrinking margins and free cash flows. But we're going to be using Ferrari as a bit of a stand-in for European auto manufacturers. By now, you guys have already mentioned it off the top of the show here. There's been the announcement from the U.S. around additional tariffs on European goods, right? So 10% to start. I believe that's February 1st, and that could escalate later in the summer if there's not settlement to some of the the broader diplomatic issues that are outgoing. And it's not yet known, and this is kind of the uncertainty, how those tariffs are either going to be applied fresh or they're going to be kind of added on to kind of existing the tariff structure that's in place. But one of the sectors that was significantly impacted was those European automakers. They took the news quite hard. So yesterday, U.S. markets were closed, but everything was trading around the world. We're talking Ferrari, BMW, we're talking across the board, Mercedes-Benz, Volvo, Volkswagen, big names in the space, all down as much as 3%. So there was a lot of red on the board. But let's take a jump into the chart. We'll look at Ferrari. Race is a symbol, very apropos, if I do say so myself, to get a broader picture of what's been going on with that particular company. So the last kind of 6 to 8 months haven't been kind to Ferrari and its stock price. We can see significant declines, since kind of early in the fall. One thing to note here, both on the Milan exchange, where it primarily trades in Italy, as well as on the NYC, had its largest ever sell-off in early October. So we can see this big gap down there hasn't been much time to kind of catch your breath ever since. You could have maybe drawn the next few weeks as a head and shoulder, but I thought it looked a little more dramatic as three kind of inverse bearish flags where we have steep pricing declines with short consolidation periods followed by big steep moves down as well. So we've got three successive big bearish moves down in Ferrari, and that's continued into recent days. We were green at the start of the day, but the trend looks like today's candle continues red, so that sell-off continues. It's one of those things. So we're now beginning to approach lows we haven't seen in over 2 years with race itself, and the broader European sector is kind of on pins and needles.
Okay, interesting stuff. Thanks for that, gentlemen. If you at home have a question for our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try the platform risk-free. You open a practice account by clicking on that Try TD Active Trader button. Then when you're ready to switch to a live account, simply export your workspace and start trading for real. It is time now for Trading Debating, and this week the stock in the spotlight is Procter & Gamble, one of the world's biggest consumer companies behind a lot of the everyday brands people use at home: laundry detergent, diapers, toothpaste. But before we get started with that discussion about diapers, toothpaste, and laundry detergent, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Option trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Back now to the stock of the hour, Procter & Gamble. What had this one top of mind for you guys?
Greg, you said it aptly. It's touched our lives in every sense.
You're not even that far with diapers in your house.
I was about to say, and I'm glad to say I didn't actually use their brand.
A little fresher than mine.
Yeah, it's a little bit fresher, but Pampers is what their banner term is, and I was on the other side of the camp. You're either Huggies or Pampers. Yeah, we were Huggies, so we raised them up. But I did use, I do sport a beard, and I might occasionally use some of the Gillette products that they have, and I grew up on that when I was a teenager. So. But yeah, so I just, it's interesting to see how they stack up. And, I think they're present over in 180 countries, 65 products is what they have. So they're globally, big, and there's no, in every household, you're using their product.
It's hard not to take a step through the house. They'll probably run into some of their products, right?
You could use, they're present in your everyday life, even if you don't know it. And this is a company that's been around for nearly 2 centuries. We're talking 200 years to be around here. That's quite impressive. And kind of one of the things I like here is tying like everyday products back to investing, and this is a perfect opportunity to do that. So.
Okay, so let's do that. We get some time on the clock. You each get the 2.5 minutes. I keep you honest there with the bell to make your cases. Now, We didn't know until right now. At least I didn't know until this moment. Draw from a hat, as always. Jason's got the bull case. Jay's the bull.
I do got the bull case. So let's start us off. So we've got a 2-century-old company. Like I said, they keep playing the hits, but they're also getting better with age, kind of like a fine wine, if you will. In terms of competition, PG has a stronger pricing power. They have higher margins. And they have continuous effective innovation that all combines into one kind of superior cash generating kind of machine. With this pricing power protects their margins and earnings during inflation and economic downturns, which some would argue that we're in right now. PG is so well diversified that unlike many of its competitors, they're not just dependent on one key product, as we've already mentioned. PG, in fact, holds either the number 1 or number 2 status in terms of global market share in 50% of the areas that they compete in. We're talking fabric care, baby care, feminine care, grooming. This scale gives it leverage, and as well, some of these brands, like we're talking, I've got it down here. So Tide, Pampers, as you mentioned, Gillette, these command premium pricing, so it's something their competitors just can't compete in. In terms of margins, they've got significant kind of advantages to their competitors as well. Their gross margins are 50%. When we take a look at some of their direct competitors, it's materially higher. Unilever, 43%. Kimberly-Clark, 36%, so big advantages there. And these higher margins allow them flexibility to invest in innovation, marketing, and produce even greater returns. And lastly, here on innovation, their R&D budget is nothing to sniff at here. It's $2 billion annually, but they're not innovating for innovation's sake. Just quickly here, one of the neat stats here was 30% of their sales volumes come from products that are either launched in the last 5 years or improved upon, so they're making that money work for them. All right, so let's jump ourselves into the chart so we can really see. So it's true that P&G has been certainly selling off over the last little bit. They're down about 16%, but one of the things that draws benefits to me, 3 of the last 4 earnings, we've seen significant multi-day, multi-week rallies coming out. But now, because we know we're in a bit of a bear trend primarily, we can start to look at near-term pricing. Recently, we've seen what we're calling a double bottom appear here. So this double bottom bouncing off lows, so we've seen support there, and we've now approached that downward trend. If we can break through, there's upside potential. And one of the things that I like to see here is if we go and take a look at some of the momentum indicators, both the RSI and the MACD are showing positive momentum, with the MACD just on the cusp of crossing over that 0 point, which is nice to see.
Okay. He seems pretty bullish.
Yeah,
he did have the bull case, but that was
the whole point.
He was bulling all over that thing. What about a bear?
Yeah, Jay painted the picture well. He's using the legacy piece of it and obviously the status of it being number 1. But, if you look at P&G and you peel the layers back, it looks like the perfect defensive staple on the label, but once you pull the shrink wrap off, you find a very slow-growing, premium-priced bond proxy is what you're going to have with negative technical momentum, which I'll just show you in just a moment's time here. Let's talk about the slowing growth, though. Jay mentioned some fundamentals stuff, but let's cut the myth. P&G it seems like a perpetual fortress, but its organic sales have softened and at times even declined year over year. Let's just take even 2025. Their revenue top line came in at $84.3 billion. That was only up 0.3%. On a year-over-year basis. Organic growth is running around 2%, which underscores it's really just a single-digit grower, which is propped by pricing and mix rather than actual unit volume strength. So they're just raising their prices to increase the top line rather than actually raising unit volume. The other thing I also wanted to mention was back in 2023, they did this. They raised the hike, 10% price hike, but volumes dropped 3% there. The other thing that I'll mention is in key categories, fabric care is one of their biggest segments. It accounts for 36% of their revenue and 35% of their profit. So it's kind of the breadwinner and they've seen significant flat or lower top line expectations in this segment as well. And then because of the exposure to so many countries and with the dollar being depressed, they've got FX headwinds as well that they've got to contest with. Then let's talk about the biggest thing is tariffs now. So they've said that they've had to, this year, they've already, in the middle of 2025, they took an additional $1 billion in cost due to tariffs. They've increased the cost of goods about 25% on U.S. products to account for that difference. And this year, management's come out and said for 2026, we expect around $400 billion in additional costs from tariffs. This is not even talking about what's happening in Europe, which is another big significant market, about 25% of it. But let's go into the charts before I'll take on more of my points. And I just have a very simple chart because this is all I wanted to show. This is all you need to look at.
So confident.
He's cold. He's cold.
Look at this March high. And we've drawn this channel. It's a long-term bear channel since March. And you can see every time This stock has gone to the upper bounds. It has been rejected. It cannot break through. You had one breakthrough, but the close the next day was back below it. This close was below it. It just had a peak up and back down. Even this time, you can see it tried to breach it, but it's broken. So you had 5 or 6 occasions where this upper bound is acting as a very strong resistance point where the stock's just not going to be able to break through.
Bear's going to bear as well. Whoa, we got a fight here. We got a fight. It was one of those things where like, good point, Jan. I was like, whoa, wait a minute. Bear's giving me something too. I don't know what to think.
We're not done yet, though.
I don't know what to think anymore. Yeah, we're not done. We got 3 minutes of country now. Get into it.
All right, one of the things that when you're the elephant in the room, sometimes it's nice to kind of throw that weight around. So I've talked about innovation, the big spend there to keep their products flowing and expanding. But one thing they also do is spend more money in advertising. They spend 10% of their sales, so it's them investing back into themselves so they can continue that organic growth. But one of the things that they're not just investing in the advertising, they're also continuing to invest in terms of share buybacks. We've got, let's see here, we've got $5 billion in purchasing of common shares coming up, but this is also true here and touched on it as well. This is a dividend king here. They've had 69 consecutive years. So this is consistent cash flow, consistent revenue generation. They've been allowed to continue that dividend going. They're looking to spend upwards of $10 billion in terms of their dividends coming up. So this is nothing to be.
Well, that's a big payout ratio, Jay, especially when they're not really increasing that top line. When you think about, just on the valuation standpoint, I want to say, like, if you think about an investment and if you want to really invest in this, you're paying right now a premium of about 20 times earnings, 14 times EBITDA for a business that's really guiding 1 to 5% on sales. And if you just take even the midpoint, which is 2.5%, 4% on the growth in EPS with, what is the yield again, Jay? Is it 2.5?
Something around there.
Sub a bonds yield? Treasuries pay more than that?
Yeah.
Okay, yeah, treasuries pay more than that. So this is really like, even I would say it's likened as a bond proxy, but without the growth aspect of it. So, what are you chasing the yields on? And then if you think about the valuation, you talked about competition. You're right. They are far and above it, but the premium, what they're forecasting for the growth doesn't add up. They trade on a price of sales at 4.3, I think 4.4%. But when you look at other competitors, Church & Dwight, which is Arm & Hammer's sort of flagship holding company, and amongst its other product, Colgate-Palmolive, and then Kimberly-Clark, they're all sitting in that 3 range. And you've got an overvaluation on a stock that hasn't been growing in the way that the market's perceiving it.
If we are thinking about yields, and one of the nice things are, if you are looking to get that nice consistent dividend, getting some pricing increasing along with it. And as I was showing earlier, we've got some pricing turnarounds that are showing after a bit of a bear trend. I want to go to the chart just ever so quickly. Well, there's a few additional signs that outside of the momentum that's been showing. We can see here, like, we've gone to a relatively short chart because we are looking to find that reversal from the primary bear trend. We've got a cup and handle that's formed over the last number of months. So we're showing as we've kind of reached towards the top end of the band.
In the last couple of weeks.
That's true. But also that also does kind of speak to the point we are in bullish territory on the Bollinger Band. We've been able to reject off the middle line, kind of supporting ourselves into staying in bullish territory, back towards the upper end, looking for a pricing confirmation on the cup and handle. So lots of opportunity for pricing increases in addition to that yield we've been talking about.
Can we just go back to my charts and just show this again?
Let me just remind people that and say nothing else.
Rejects off the top and it tends to go to the bottom, which is around this 130 level here. So if you get back there, then you're back in valuation zone again.
All right. This is a good debate. I'm liking this now. Well fought, gentlemen. Well fought. You're going to take us into the platform, show possible option strategies. Why don't we go with Jay first on the bull side? Yeah,
let's start here. So this is an interesting trade here. We're going to get a little unique with the trade. We're going to do what's called a zebra trade. So that's a kind of a commonly used acronym called zero extrinsic back ratio. So just to kind of explain that, the opportunity that somebody could take here is we're going to be buying 2 calls and then selling some that's deep in the money. Well, that means it's going to have zero extrinsic or close to zero, meaning it's going to have less exposure to volatility and less exposure to time as these options decay and work themselves to expiration. But options like that, they tend to be expensive, right? They're deep in the money, so you're paying for that intrinsic value of that option. So you can take an opportunity to sell one option that's closer to the money to reduce the premium that you'd be paying here. So let me just get my chart set up, and then we'll jump into that and talk it through here. So let's get that going here. Let me jump back out in the time frame here. So lots going on this chart. So let me bring it back. Actually, let me get my study up. Sorry, everybody. There we go. All right,
it's gonna be worth it.
It's so worth it. So what we're looking for in this particular regard is, where are we at? Where's my strike is way down low. Either way, the strike that we're thinking of buying is going to be the 130, and we're thinking about selling the 145. Both strikes are in the money. This is an opportunity still, because we are net long in terms of these calls. This is still gives us unlimited upside potential. The higher, if we do tend to believe that P&G can see a 10% gain, we're actually not. To make ourselves money, we're actually in this particular regard. We're not even needing for us to go outside of the market maker move out to the expiration on these options. So if we can get that upside move, we have bought that time to limit our volatility, limit our time exposure. So this zebra trade, buying 2 130s, selling one of the 145s, expiring out, taking on a little bit more time to give ourselves exposure to where we've seen historical bullish movement over the last year or so at around earnings events. This gets us out to the middle of the year. In this particular case, we're paying around $27 to get this. So it's a big investment, about $2,700 each particular contract. But we do give ourselves lots of upside, and we're able to still maintain that bullish stance over a longer period of time.
All right, so risk and reward here if you're playing a strategy.
Yeah, so I mentioned that it's an unlimited upside potential here. So the higher it goes, just like stock ownership, the more we're going to make. But with any debit trade, the risk, in fact, to us here is going to be what we pay up front. So if this is a directional strategy, if it doesn't move in the way that we're expecting it to, the premium of the $27 per share or $2,700 per contract is what's going to be our risk in this particular case. But this doesn't necessarily need to be a ride it into a ground type of trade. So if your perspective changed or if your risk tolerance changed, feel free to manage as you roll into expiration to kind of pull back and limit some of those losses if it doesn't go your way.
All right, interesting possible bull strategy there. How could a bear possibly play it?
Yeah, Greg. So looking at the bearish side of it, if we look at the charts and if we anticipate it stays within that channel and can test the lower bounds, we want to play a directional move down. There's other couple of reasons why I also want to look for a directional trade. Looking at the profile of P&G and the options leading into earnings, we look at most option traders will look at what's known as the implied volatility. What's the expected volatility? And usually when volatility ticks up, like north of in the 50th percentile, it's more conducive to be a rider of options. But if it's lower, we think volatility can pick up, then we want to be a buyer. In this case, we're going net long on the options trade. So the trade we're looking to put on, or one could consider putting on for directionality, is a long put butterfly spread. And so here's what's happening coming into earnings. The expected move on P&G for the at-the-money options is about $6. So going into this earnings print, about $6 to the top. To the bottom side is what the market's expecting at least. The way this trade works is we are really focused on reducing the cost of the trade. And so that's why we've got 3 legs as part of this trade. So one is we're going to buy the 145 strike put, which is currently just sitting at the money strike right now. We're looking for the February cycle to just give us a little bit of extra time so time decay doesn't get a hold of it. And then we're looking to sell where we think there could be a natural area of support in the market. And maybe 135 is the area where we think there could be buyers stepping back in to prop up the stock. And then for the selling out the 125 to just cap our risk, because we're selling 2 contracts on the 135. But we need to define our risk, so we're going to buy 1 contract on the 125 here. So it's 3 legs to it. It's $10 widespread is what we've chosen. This has brought our debit down to $2.50. So in other words, it's a tenth of what Jay's paying. $250 is what you stand to lose there. On that trade. And I've got a little magic reveal because you're going to ask me.
Magic reveal, risk and reward.
All right, let's lower it up here. All right. We'll start with the risk because it's a directional trade and it's a debit trade. So you end up losing what you paid for it. In this case, $2.50 on a single contract, or $250, and that's going to happen if P&G in fact goes the direction we don't want it to go into, and that's on the upside or stays above the 145 strike. Also, we will kind of lose on this trade if the price falls outside of the wings, I should say. So this is one wing, the 145 on the top side. But if it in fact falls dramatically below even 125, then it kind of nullifies anything we've made on the directional side of it. Best case scenario though, max profit is when it's going to stop right at the body of the butterfly is what we call it, which is our short strike. So if it takes a break at 135, we'll realize the full profit, and that's simply calculated by taking the spread, $10 minus what we paid. $7.50 is our profit, or $750 in this case.
All right, interesting possibilities there and the options trades on Procter & Gamble. Thanks for laying out the bull and the bear cases for P&G as well. And just a reminder to our viewers that this debate was for educational purposes and does not reflect our personal opinions about the stock. Before we move on, Jason, you're going to elaborate on using filters to diversify into specific sectors.
Yeah, I think there's some really interesting, useful tools built right into the platform here. So maybe you're thinking, if you're seeing the news and you're noticing a particular sector, it's like, maybe I need to get some exposure there, or you're looking to find out, what are the players in this particular area. Active Trader's got a really helpful tool, and it's easy to understand. So let's jump in, and I can show you exactly how that can be used to your own advantage. All right, so we're on the chart tab. We're going to go up to Market Watch. This is where Greg finds his trusty heat maps here as well. So where I want to bring everybody is just right into the watch list that's on this particular page. I'm going to bring us up to the name of the watch list just by clicking on that. One of the things with this menu that pops up gives us lots of different choices here. I want to focus in on this by industry look. This now breaks the market down into sectors for you to choose and find the players of a particular space. So for instance, you've got basic materials, you've got financials, you've got consumer defensive. Those are all different opportunities for you to move into. If we move ourselves down into industrials, one of the things that's on a lot of top of people's mind is how do I find stocks that are in the defense space? So under industrials, if we move down here, there's an aerospace and defense list. I can quickly bring it up, and now I can see all of the companies. There's going to be all sorts of sizes and all sorts of focuses for the company. But there you have it. You've got that sector right up there ready to use. But the ability to filter doesn't stop with choosing the list. I want to kind of really show you just an easy way. You can apply this on any metric that's on the watch list. You can filter either by clicking on the label of the column, so just by last price to sort of either an ascending or descending order. Or what's really neat here, we have this kind of filter function built right into the watch list. At the top of the screen, if I hover my mouse over the last price, you can see this little funnel. If I click on here, that's the filter icon. It allows me to filter minimum and maximum values. So maybe I want to put in, let's just say pick a round number here, $10. So now I've not only filtered for aerospace and defense companies, but I've also filtered them for looking for maybe something that's a little less volatile with a little bit more price. I filter for companies with over $10, and there's my list. Gives me a little bit of a smaller kind of segment to start digging in and do a bit of research to find out what's right for me.
All right, powerful tool there for our audience. If you at home have a question about the TD Active Trader platform, or if there's a stock you want to see our debaters go head-to-head on, just send us an email to td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. If you scroll down, you're going to find a tab that says Join a Live Masterclass this Wednesday, 2 p.m. Galen Cormier is hosting an interactive session about TD Active Trader. He's going to explore all the main features the platform has to offer. Registration is open now. Before we wrap up the show, we're going to take a look at some of the other key things investors are focusing on for the rest of this week. What is on the radar, gentlemen?
Yeah, Greg, we've got on the macro front, we've got a few key releases that are going to happen. And this is all in anticipation for the big event next week, which is the Fed meeting, the announcement there. And so one of the key releases that's going to take place is going to be the PCE release. This is going to actually be November's one still. We're still sifting through that data. Remember, the PCE is the Fed's preferred measure of inflation. It'll be closely watched, especially after the jobs numbers have seen some signs of improvement. They just want to see if that story gets corroborated on the inflation side of things. Expectation is to rise by 0.2%, coming both on the core and headline at 2.7% there. Now, remember, softer inflation data in addition to better jobs could potentially put the lid on prospects of another interest rate cut this quarter. If it comes in a bit hotter, then that conversation might be back on the table. And then finally, the other thing to look at is the GDP. This is the Q3 revised one for GDP. Remember, GDP came in, I think it caught everyone by surprise. 4.3% was what it was in Q3. And so that initial estimate is going to be retested and see if it's still holding there. But I think on the news front, we've got something happening in Davos, I believe. That's
a
little thing, right?
Yeah, a little thing there.
Some of the well-heeled thinkers of the planet are gathering.
Yeah, they're all gathering there, and leaders, of course, and namely the United States will have representation. Mr. Trump will be speaking, of course. I assume it's going to be political in nature more than anything else. So that'll be one to keep an eye on, just see directionally where the markets really want to go with, based on what he's saying. I think he's due to speak tomorrow, in fact, his first engagement. But turning back to earnings, because we're getting into the thick of it now.
Yeah, Intel was one of the few bright spots on the screen today. Let's see if it's still the case. But tell us about Intel.
Yeah, let's talk about Intel. So they've got earnings coming after on Thursday after the close. They've had a historic run in 2025. I think they closed around 140% as well. They've had NVIDIA partnership as well. The government's obviously a major shareholder now in Intel as well. So this this is their Q4 25 earnings. Expectation is 8% or 8 cents EPS, which is still going to mark down almost shy of 40% on a year-over-year basis. And the revenue is at 13.4 billion, which is down at 6%. But remember, they've had a lot of rejigging in 2025, so they're seeing a bit of an uptrend. But the key news is CES took place, and they're delivering on some of the promises that they came out with. So investors probably want to keep a key eye on one is their 18A chip technology, which is powering CPUs. So I think what they called it Panther Lake, which is the Ultra Core Series 3 processors that's built on this new node, 18A. And they've got Apple on board as a customer for these chips, which they're going to be powering the lower-end Macs and iPads as well. And then TSMC, when they reported last week, they in fact said to their biggest lead clients, NVIDIA and Broadcom, that they're stretched thin on capacity. And what this means for Intel is it probably provides a little bit of window of opportunity where they could see ramp up and possibly get them as customers for their foundry business, which they're trying to reignite on that front. And then the final thing I'll talk about is Intel's AI CPUs. Remember, up until now, AI was all about large language training, and now it's about inference. And inference requires process of running these models at scale, and it requires increasingly heavy CPU usage. And Intel's in fact said that they're nearly sold out for the year on their CPU capacity. So we'd probably want to just see if they confirm that story. But looking at the charts over here, we've seen it come out of the doldrums. They've just been in this range-bound action throughout last year, leading at the end of 24 into last year. But then they finally got a bit of a break. And I wanted to mark two things why I wanted to show it this far back, because when they sort of fell from grace, we saw this big gap down event happen. They never were able to claw back into it. And then, of course, to come out of this range-bound action, it gapped up again and started this new channel over here. What we've seen recently is we've seen at the end of the year, we've seen this telltale sign, which is a W stands for win. It's a bullish reversal pattern. So we've got this breakout happening on the top side, which is the key support at 45. It hasn't retested it on the bottom side. So if we do see a pullback, I do want to see a retest at the 45 to really confirm that's the new level. But going into this earnings print, many analysts are calling, and based on how the price is trending, to tag that $60 level, which it's not far from. If it comes to the downside, I think you test the 50-day EMA, which is sitting squarely at that $39 price level there. So we'll see how that earnings comes out on Thursday.
Interesting chart, and it's an interesting heat map today too. Intel definitely standing out in a sea of red. The stock's up almost 7% during this session. You have an aerospace, or at least a company with a division, an aerospace division.
Well, that's the thing. We're talking GE Aerospace, right? So GE is no longer the kind of catch-all company with its fingers in everything after years of restructurings and spin-offs. But that doesn't mean some of its now kind of independently run businesses kind of aren't worth kind of some own look on their own merits, right? So GE Aerospace has been in the news lately, and in aerospace field, that's not always a good thing, but this looks to be a positive story from them here. It was announced that I believe it was late last week, that Delta Airlines has selected GE's new engine. This is GE Gen Next engine for its new purchase of the Boeing 787s they've just made. So financials weren't disclosed. What I thought was really kind of important here was that they have also signed not only to supply the engines, but also kind of those very lucrative kind of aftermarket products and services, kind of that agreement, which is definitely a plus for them. And this is already on top of the $1.4 billion contract. It's an expansion of a contract that was actually spoken about earlier this month with the Department of the Navy and the Marine Corps. So that's a big plus for them. Another thing I'll take away from all this engine talk is what GE's they're claiming, that as a passenger they're saying they're 30% quieter than existing engines. So that's a win for travelers.
You don't mind sitting in the
I look forward to it.
Yeah. There you go. So this is a nice thing. But let's just jump into the chart and we can take a look here. So earnings per share, we're expecting a year-over-year increase up to about $1.43 from $1.32 last period. Revenue up 13%, but looking forward to hearing about orders, but also deliveries, because they've taken a focus, kind of a lean methodology to kind of increase outputs, but also reduce backlog. So that'll be an interesting topic of conversation. But by and large, GE has been on an upswing. I've got two kind of concurrently running channels, kind of one much tighter that is running in for the better part of the last 6 to 8 months. But we did kind of break down below that, but then we tested off kind of that broader channel. We've had a cup and handle formation that was kind of forming later. One of the nice things to notice here is with the momentum picking up, we did cross back above the 21 and the 50-day average and up towards where that measured move on the cup and handle might see us going. Nice thing to notice here is that we're kind of once again hoping to reemerge back into that narrower channel, but we can see that there's still room to move. I've got the money flow index at the top of the screen, so we're still positively trending in the upward direction. It's still room to move before the 80 overbought zone is in place. So when earnings come up Thursday before the market, it'd be interesting times for sure.
Lots to chew on there, guys. Thanks a lot for another successful show and leaving me with lots to think about, and the audience too. That is the show for this week. We're back on Thursday at 10 a.m. Eastern Time. We'll be speaking with Jonathan Corpina from Meridian Equity Partners. As always, investors should perform their own due diligence before engaging in trading. Thanks for watching.